LEG Immobilien is one of Germany's leading residential real estate companies focused on sustainable growth, tenant satisfaction, and long-term value creation. Today, Frank Kopfinger, head of Investor Relations, presents the 9-month 2025 key financial figures, highlighting performance, portfolio development, and the outlook for LEG Immobilien. Frank, the stage is yours.
Hello, I'm Frank Kopfinger, Head of Investor Relations and Strategy at LEG. With our 9 months results, we provided the markets with a couple of highlights, which I'm going to address in this short video. After the first 9 months, we are fully on track for our 2025 guidance, i.e., we aim for an AFFO growth of 10% per year. For 2026, we guide for an additional growth of 5% in AFFO. We stick to AFFO as our core KPI, i.e., cash generation remains our core principle in this environment. At the same time, we have included FFO I as part of our guidance for 2026. Thirdly, we remain constructive on valuation and expect a positive valuation result of 1.5 to 2.0% for the second half of 2025. Fourth, disposals remain one key lever to bring down our LTV to the target line of 45% in 2026. We have already sold more than 2,200 units for around 190 million euros so far. And we remain very positive to see signings until year-end 2025, based on the current state of our sales pipeline. And lastly, the last highlight for this quarter is certainly Moody's. Moody's just recently confirmed our Baa2 rating and revised our rating outlook to positive. Regard this as a recognition of our efforts to protect our balance sheet via non-complex measures and the cash-focused steering of our group. Let me now walk you through those highlights. So after the first 9 months, we achieved an AFFO of 181 million euro. This is an increase over last year period of 19%. The strong result is driven by several factors. First, the rent level grew by 7%, A, by the acquisition of BCP, which we fully integrated at the beginning of this year, and B, by the like-for-like rent growth of 3.1%. Please note that while the 3.1% growth is below our target range of 3.4 to 3.6%, we are confident to reach our target range by the end of the year. As on a year-on-year comparison, we had a more front-end loaded rental growth last year, while this year is more evenly spread throughout the year and the required rent increases are already fully implemented by now. Second, we had a broadly stable cost base. This is why we increased our adjusted EBITDA by even 11%. And this resulted in a very strong EBITDA margin of 79.2% after 3 quarters of 2025. Third, we continue to benefit from low cash interest costs, which remained low at 1.59% for our entire debt book of around 10 billion, with an average maturity of almost 6 years. And overall, this led to an increase of the FFO I by 13% to 371 million euros and the AFFO by 19% to 181 million euros. We are therefore confident to reach our 2025 guidance, which we confirmed, EBITDA margin of 77%, as well as an AFFO in a range of 215 to 225 million euro. This suggests a 10% increase over the AFFO of 2024. And with this, I come to our financial profile. We believe we are well positioned in the current environment, where we saw a high volatility on the bond markets overall. All our remaining 2025 maturities have been already addressed for quite some time. And by now, also all our 2026 maturities of roughly 1 billion euros are covered by our strong cash position or new refinances. This includes the 500 million euro straight bond, which is due early 2026, and which represents half of next year's maturities. After the redemption of a 400 million euro convertible in September, as well as the payment of our dividend, our cash position remains strong with 448 million euros. Our average interest rate stands at still very low 1.59% at the end of September, while the average maturity remains also high with 5.6 years. The LTV stood at 48.3, which is slightly up over the H1 level, but we expect to reach the target of 45% in 2026. The interest coverage ratio stands strong with 4.5 times, reflecting our earnings power on one hand and our low interest costs on the other hand. And with this, let me briefly walk you through our new guidance for 2026. We expect the AFFO, our main KPI, to grow by 5% to a level of 220 to 240 million euro. This will be driven by a rent growth of 3.8 to 4.0%. So the rent growth is to increase by around 40 basis points over 2025 and reflects the positive contribution from the cost rent adjustment of our subsidized units. We expect the EBITDA margin to improve towards peak levels of 78% again. We continue to invest significantly into our portfolio, more than 35 euro per square meter, so quite in line with this year's investment. And as I said, on LTV, we expect to reach our target of around 45% next year in 2026. This will be driven by a mix of further valuation effects as well as by disposals. Certainly, faster disposals can shift the timeline forward by when we achieve the 45%. And with this, I come to the end of my short video. I hope it gave you a good overview of our 9 months results 2025. And you certainly find all the entire reporting set on our webpage within the IR section. Should you have any questions, then please do not hesitate and contact me or reach out to the team. Thank you and goodbye.
Thank you, Frank, for sharing these valuable insights into LEG Immobilien's performance and outlook. For investors seeking more, visit Seat 11A to explore additional videos, including the elevator pitch, financial results, and deep dive presentations, offering a comprehensive view of LEG Immobilien's strategy and long-term value creation.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.